Welcome students. So we are discussing the preparation of financial statements with adjustments, and we will now carry forward with where we left in our last lecture. So we prepared this balance sheet, and before that we prepared the trading and profit and loss account. So two financial statements we prepared, and we have checked that yes, both the sides are balanced. So financial position of the company is okay, it is balanced. Here some points of concern are, which I would like to discuss with you before we remove this balance sheet and prepare a new balance sheet. Well, number one, as I told you, the headings are different. In the profit and loss account, it is the profit and trading and profit and loss account of the company for the year ending on. I already told you that it depicts the profit or loss situation of the firm, means the total transactions and profit and loss situation of the firm for one accounting period or the one full year, 12 months. It can be any accounting period starting from January to December, April to March, it may be from October to September, it may be from July to June, anything it can be, but it has to be a period of 12 months. But in case of the balance sheet, we put the word as on, means this statement is depicting the financial position only for one day and not even on, say for example, I have written 30th September 2011. The balance sheet position may be different on 29th September, it may be different on 1st October. Maybe this side can be more, this side can be less, it can be imbalanced balance sheet on 29th September, it can again get disturbed on 1st October. But on 30th September, this balance sheet should be balanced because this is the date of the finalization of the balance sheet. If we are able to prove it that on 30th September, on the date of balance sheet, we have a balanced position of asset and liabilities, it means we are not worried about what was the situation, financial position one day before and what was the position one day after. So we have not to worry about that. Now this is the one thing. Second thing is, we are saying that depreciation we charge, because for the reduction in the value of the fixed assets, we charge the depreciation. We charge the depreciation only on all the fixed assets, because we have the assets normally of the two categories. One category of the assets is the long term assets and the other category of the assets is the short term assets. Long term assets are called as fixed assets and the short term assets are called as current assets. Generally we put the long term assets on the upper part of the balance sheet starting from here to somewhere here, and then in the lower part it is the current assets, we put the current assets here. Now how we decide that which asset is a fixed asset and which asset is a current asset? The basis of describing or distinguishing between the two category of the assets is that the assets which have long life. Long means how long it is? A period of more than 1 year. Any asset, any property of the firm which has a life of more than 1 year, 12 months, more than 12 months, 1 year, that asset is considered as a long term fixed asset, and any asset which has a life for the firm of say up to 1 year or less than 1 year, that asset is considered as current asset. For example, now you talk about the land and building, they have the longest life. Land has the longest life, but this is basically we are talking about the land and building is that part which that particular piece of land on which the building is constructed, because number one, we do not charge any depreciation on land. Land value never depreciates, normally it appreciates, but that appreciation is never recorded here because we prepare the financial statements of the firms on the basis of historical cost. And with that concept of the historical cost, we prepare the balance sheet and profit and loss account on the basis of the book value, not on the basis of the market value of that asset. So at what price that asset has been purchased, that we will keep on showing in the balance sheet. Maybe any asset, say for example this land and building today is of not 25,000, it is of 25 lakhs, it has gone up. So it may be a different situation, but in the books of accounts we will keep on showing at a price at which it has been acquired or it has been purchased. So we show, so it means we are showing here that it means on this particular head we are showing depreciation. It means this is that land on which the building is constructed. It is not other open land, and that land on which the building is constructed, that land is known by the building, and land disappears. So it means this is basically the price of the building, the cost of the building 25,000 rupees, 2625 worth it has depreciated. So it means the final value of the building is 24,375. So it means this is a fact worth noting that on the land we never charge any depreciation. Land value never depreciates, it appreciates, but since we never record the appreciation because these accounts are prepared on the basis of the book value, so we only show the land on the basis of the historical cost or at which it has been purchased, and we never depreciate it also. All other assets, fixed assets, always depreciate when the time passes because of the wear and tear, because of the use, because of the obsolescence, because of any other reason, oxidization, because of any other reason, the price or the value of that asset goes down, decreases. So we will never account for that. So it means finally if the value of the asset decreases, we will have to charge depreciation on that. So other than land, all fixed assets are subject to deterioration in their value, and that is recorded in the books of accounts by way of depreciation. So we charge the depreciation on the fixed assets here. Then once our fixed assets are over, say for example land and building has a life of more than 1 year, similarly plant and machinery has a life of more than 1 year, then in this case furniture and fixtures have the life of more than 1 year. So we have shown first and we have charged depreciation on them, and then after that we have the, from this particular point the current assets have started. We have the current assets here. Current assets means now here onwards we have the current assets. Bills receivables, as I discussed with you at length, bills receivables are only for a few months, their life is only for a few months, not for years. So it means it is a current asset. Sundry debtors are also for a few years, so it means it is a current asset. Cash is limited, today you have cash, tomorrow you spend it, so it goes away. Cash in hand, cash at bank, it is finished. Similarly the fire insurance, the premium is paid only for a year, not more than that. So maximum is, if it is paid in advance for the next a few months, so it will be over. Rates and taxes are paid monthly basis, so they are paid in advance for a few months, so they will be over. And similarly the closing stock of the previous year is to be sold in the current year and maximum in a few next months. So it also has a life of less than 1 year. So those assets which has a life of less than, means maximum of 1 year and less than 1 year, they are current assets, they are shown on the lower part of the balance sheet, and those assets which have a life of 1 year or more, then those they are called as the, means the assets which have a life of more than 1 year, they are shown upper part and they are called as the permanent or the fixed assets, right. So this is all about the asset side of the balance sheet and all the titles. You have to be very careful, means in the say learning accounting and preparation of financial statements, it is generally said that these figures may be wrong, it is acceptable, not worry about it. Total may not tally, acceptable, but if the format is not correct, say for example you are writing here balance sheet of Waterfalls Limited, Private Limited for the year ending on, it means everything is wrong. Maybe you have put everything right here and you have tallied both the sides also, but that is found as incorrect, wrong. Nobody can consider it as a correct balance sheet, you will get 0 marks. Similarly in the profit and loss account, if you write here say for example balance sheet of, or sorry, profit and loss, trading and profit and loss account of Waterfalls Private Limited as on 30 September 2011, it means everything is gone, is wrong. You have calculated, you put the items on the debit side correctly, on the credit side correctly, you have shown all the items, you have calculated profit and loss correctly, everything is right, but if the format is wrong, you are gone. So we have to be very, very careful that our format should be correct, and then figures should also be correct, but in any case if there is some problem in the figures, that is acceptable, but format should be very, very correct. Now we will come to the liability side for a while and I will discuss certain things with you. which you will not find in the books generally at this level which you are studying and you are learning financial statements preparation and their analysis. When we talk about the sources side, this is the sources side I told you, that is sources and applications. Sources side, when we talk about sources of funds. Now generally, as I told you, the assets, they are generally of two categories, long term assets and short term assets, that is the fixed assets and current assets. Similarly, the sources of the funds are also of not two categories but of three categories. Sources of funds are of three categories. There are long term sources, permanent sources you can say, then there are short term sources, and the third category of the sources of finance is spontaneous sources of finance, spontaneous self adjusting sources of finance, we call them self adjusting sources of finance. Short term means even shorter than short term sources of finance, they are called as spontaneous finance. Now what are the, how to identify it? Say for example, you talk about the capital. Capital is a very long term source, means capital will come on the first day when the business, we will start the business, and capital will be paid back to the owner when the firm is closed. So it is a permanent source, longest life, and capital will never be withdrawn by anybody, it will not be reduced, it will never be paid to anybody. So it is the longest most source, that is why we put it on the top of the balance sheet. You call it as capital, or in public limited companies you will find it share capital. So share capital is the longest item and we put it on the top. Then we keep on adjusting it by way of net profit, sometime it increases or decreases or something. If the profit is there, capital will appreciate. If loss is there, capital will go down, but loss cannot be allowed to be there in the firm for a longer duration, because otherwise there will be a continuous capital erosion and the capital will come down to zero. So that is not allowed. There can be loss in 1 year, 2 years, but after that when there will be profit, capital will be appreciating, but the capital will be a permanent most source. Then in the next balance sheets we will learn about the other sources. Say for example, after this the second longest source is the long term loans, borrowed finance, long term loans. We will put here in this problem, long term loans were not there, but otherwise there will be the long term loans. First the owner invests his own money in the business, that is called as capital. Then if there is a shortfall, he borrows the money from the financial institutions in the form of the long term loans, and those long term loans become the second source of finance. Long term means the funds borrowed for a period of 3 to 5 years, they become the long term loans. Similarly, you must have heard about a term debentures. Debentures are again the long term borrowings. In the common language we call it sometime bonds. So they are bonds also. Debentures means a kind of bonds, a document which is acknowledging the borrowing of debt by the firms, by the business firms, from the people or from the financial institutions or from any other institution. When any money is borrowed and any document is issued which is called as a bond, that bond is a source of long term funding, and generally companies issue the bonds in the market for raising the funds for the long term funds, and these bonds are issued for a period of 3 to 5 or sometime 10, 20 years also, very long term bonds, 20, 25, 30 years bonds are also there. So these bonds, so difference between the bonds and debentures is, in the different countries different names are there, but in India if any such debt taking instruments are issued to the public or to any lender by the government, if any money is borrowed by the government from the general public, financial institutions or maybe from any other institutions, other sources of finance, and any document is given as a recognition of that loan, that borrowing, that is called as bond. In the government borrowings case it is called as bond, but when the private companies or public limited companies, joint stock companies, when they borrow money from the public and issue them a document kind of, means when they issue the bonds to them, recognizing that we have borrowed this money from the public and we will pay it after some period of time, they are called as debentures. I will discuss with you the debentures sometime later also, and we will discuss more complex forms of the balance sheets, but the basic difference is the that if any bond is issued by the government, it is called as bond, but if any bond is issued by the business firms, it is called as debentures. That is a basic difference in the name in the Indian scenario. So, bonds and debentures are the third category of the long term source, which again has a life of more than 1 year, maybe normally that is 3 to 5 years life is there for the bonds and debentures also. Then once these sources are, and similarly it can be say long term borrowings from the banks or financial institutions. So, you have capital, you have long term loans, you have debentures and bonds, these are the sources of long term finance. Then we come to the second category of the sources of funds. They are called as short term sources of the funds. Short term sources of the funds means funds borrowed from those sources which have a life of total duration of that borrowing is only 1 year. You cannot extend that say repayment of that loan beyond 1 year. You have borrowed that money, maybe the money or anything in kind, maybe the goods also. So, you will have to pay within next few months. You cannot keep on say delaying the payment much longer. You have to pay and you have to settle that claim within a period of maximum 12 months. These borrowings are called as short term borrowings. For example, we have taken the short term loan from financial institutions. Short term loan from financial institutions, say banks. When we borrow money from the banks, they are called as the short term loans or the short term borrowings. And banks borrowings are to be taken for the short term purposes. For example, we want to buy raw material, we want to pay the salary to the employees, we want to pay the wages to the workers, we want to pay the utility bills, electricity, water and other kind of things. Sometimes we borrow money from the banks under different arrangements. That money is borrowed for a limited period of time and that has to be paid in that period of time, and that is called as the short term loan. Similarly, you have say other kind of, say you can call it as other sources from where we are borrowing the short term, any not banks, maybe financial institutions or any other institutions who are lending to the business firms for the short term purposes, means for a purpose of say short term duration, a few months, and it has to be returned back within a few months, then it is called as a short term loans. So, here in the balance sheet, top of it is a capital, then long term loans, then debentures or bonds, then the short term borrowings, short term loans from banks or other financial institutions. Then we talk about the third category of the finance, and that is the spontaneous finance, spontaneous sources of finance. Spontaneous sources of finance, these are the third category. You must not have heard in the anywhere that we have the spontaneous sources of finance also. And spontaneous sources of finance, when we talk about, we have spontaneous sources of finance. And what are the spontaneous sources of finance? I told you that the second name of the spontaneous sources of finance is self adjusting sources of finance. Means for that you need not to say ask every time, you need not to go to the bank, do the documentation every time, apply for the loan, get the loan, return the loan. That is not required in this case of the sources. This is automatic, means funds keep on coming and they are paid also on the due date. Now, they are not funds in the real sense, they can be a kind of services, kind of goods, kind of material that keeps on coming and that is used by the firm, converted into finished goods, and then the payment is made to the suppliers. Now, for example, who are the spontaneous sources of finance? Suppliers of raw material. We have written here one item, that is sundry creditors. They provide us raw material. Suppliers, we have a long term arrangement with the suppliers that you will supply us the raw material regularly. You will supply us the raw material, we will use that raw material and you will be paid from the date of supply, from the date when we receive the material in the firm, when it will come, will reach us, when we will receive it within 60 days, means after 60 days from the date of receipt we will make you the payment. So, it is automatic. Fund material is coming, is being received, kept in the warehouse or in the store, and on the 60th day automatically either the online payment will be transferred to supplier's account or that check will be issued or whatever it is. And so, it means symbiosis is going on. He is supplying the material and the payment is going on the due date, and no need to say you can call it as have the fresh negotiations or the fresh documentation, fresh application, anything, nothing is to be done. But when you have to borrow long term funds, you have to go to bank or financial institution, negotiate with them, apply for the loan, and then to take that loan, and then to do this and that, so many formalities, and once you return the loan, that account is closed. Same is the case with the short term funds. You have to borrow money from the bank, so you go to bank, you apply, you get the funds, you use the funds, you return the funds back, and after that, that source is closed, provided if it is not a cash credit limit. We will discuss it later on, what is the cash credit limit. So, we talk here about the spontaneous source. It means there is a regular supply. Supplier is supplying material, he is being paid on the due date, and this cycle is going on. No fresh negotiation, so it is a spontaneous self-adjusting. For example, second example, you talk about the wages we are paying to workers. When the workers start working in the firm or in the plant, they work on the day 1 and we pay them after 30 days or 31 days at the end of the month. They are giving the services to the firm for 30-31 days without asking for any money. You are getting a virtual credit of 31 days, 30 days or 31 days. You are getting that credit, automatically that credit is coming to you. Are you going, asking the worker, negotiating every month? No, we are not negotiating with them. So they are working and they know it, after 30-31 days I will get the payment. So it is a self-adjusting spontaneous source of finance. He is giving you, every worker is giving you a credit equal to his wages for a period of 30 days. Talk about the office employees. When they are getting salaries, they are getting salaries after 1 month. So they are giving a spontaneous credit to the firm for a period of 1 month. Talk about these utility bills. We are getting power supply from the power board. We are getting water supply from the water supplying organization. You are getting so many other kind of supplies, small supplies, lubricants, oils, something. We pay them after 1 month. So it is a self-adjusting source of finance. When we pay the power bills, it is automatically in our mind that power bill will come after 1 month and we will pay it. So we never think it about, we never renegotiate, we do not do this or that thing, and we pay it when it becomes due. So they are called as the spontaneous sources of finance. So it means they are the spontaneous sources of finance, and means we have the 3 category of the sources of finance. First is the long term source of finance, second is the short term source of finance, and the third is the spontaneous finance, self adjusting source of finance, that automatically we pay them and they supply raw material, they give their services, something like that, and automatically that process goes on. So this way you have the 2 sides. One is the your liabilities and capital side, other is the asset side, and when we put these sides on each other, then it is called as a balanced balance sheet. Now the another concept I will discuss with you is that, for example, I was saying that if both the sides of the balance sheet are balanced, then we can say that the financial position of the firm is fine, it is okay, it is good, and it is balanced, good. But if it is not balanced, what will happen? If it is not balanced, what will happen? It means either this side is bigger and this side is shorter, or this side is bigger and this side is shorter. Either of the 2 things will be there. Now if this side is bigger and this side is shorter, what does it mean? Your liabilities are more, your assets are less. It means we have borrowed more money from the market, including shareholders, and we do not have a proper account of that. It means how long that situation can be allowed to continue. If somebody asks, because these financial statements when we prepare, they are not considered as authentic financial statements until they are audited by the certified auditors, and these auditors are chartered accountants. They are certified chartered accountants. Every business firm, especially company form of organizations, they have to appoint their auditing firms, and chartered accountants are normally the certified auditors. Now when this balance sheet is imbalanced, and if it is presented by the company in front of or before the chartered accountant, he would say it's imbalanced balance sheet. Your liabilities are more than assets. It means this firm is almost bankrupt. You have borrowed more money from the market, you have misappropriated the funds, you don't have the proper funds with you, and then it's a imbalanced balance sheet. So how long this situation can be continued? So firm has to correct this position if they want to intend to continue if the management want to continue with the business. Otherwise they will have to declare that we are not able to rectify this position, our liabilities are more than the assets, we are a bankrupt firm and we cannot correct this position, right. There can be reverse also. This side is bigger than this side, and if it happens, it's a very good situation. If the asset sides are more than the liability side, then this situation is very good. Now if normally what will happen, if this side is more than this side, it's a very strengthful balance sheet. So what we will do, for example here we have the total of this side is say for example this is 1,19,128 and the total of this side is 115,000. Total of this side is 115,000. 115,000. So 1,15,000. So it means you have the properties worth 1,19,128. You have liabilities only 1,15,000. It means you have assets to the tune of 4,128 more than the liabilities of the firm. Now we will also not keep this kind of the balance sheet in front of the chartered accountant, we will balance it. Normally what happens, if this situation comes up, then this is not allowed to happen. Firms will withdraw the extra assets from this side, maybe the extra cash, and they will transfer it to the another reserve which is called as hidden reserve or the secret reserves. The concept of hidden and secret reserves I will discuss with you in my next lecture, but that will be transferred, and again so for example the excess amount here is 4,128, that will be withdrawn by the firm and will be transferred to a hidden or the secret reserve. So again both the sides will become 115,000 rupees. But if the firm does not want to create the hidden or secret reserves, in that case what will be there? This side is 1,19,128, this side is 1,15,000. So we will have to make both the sides equal, and we will show here that we will make it 1,19,128, and the difference will be, we will put here profit and loss account, and that amount of 4,128 will be shown here. Means now everybody understands that if this profit and loss, because we have two kind of profit, one is the net profit which is added here, this profit has come from the profit and loss account, fine, and we have added this in the capital, and we have put another account here, profit and loss account. It means what this account means, this profit and loss account means that this is excess of assets over the liabilities, and this excess of assets over the liabilities we are putting in the profit and loss account side, and we are showing it here. So the balance sheet is again balanced, but this amount is extra. It means 4,128 rupees of the cash is extra. If you talk about all these sources will be less by 4,128, and the cash here is more. So it means we are showing here we have earned from these resources whatever we have earned, and showing this side it is more. We have done the very good business in a very good form, and then the extra profit we have earned is we are showing it here, and then this is called as 4,128. So it means we will have to again the balance sheet, and we are putting extra of this side, excess of the assets over liabilities in this side, and we are again balancing the documents. So there are some very interesting components which are there in the financial statements, that if this side is bigger, this side is smaller, what it does it mean and what to do, and if this side is bigger, this side is smaller, what to do. And again we will talk about certain other important interesting concepts, and we will do some more complex problems also, but that in the in my next lectures, means the remaining part, more complex forms, more interesting concepts about the balance sheet and profit and loss account, we will discuss in the next part of discussion. Thank you very much.